So the question that we're going to pose today is, are mortgage rates going up or going down? We're going to talk about that. We got a little bit of a workshop here. Are mortgage rates going up or going down? And the answer to the question is yes. If we look at where mortgage rates have been throughout the year, we can actually see, and we've got a chart there, and let's see if I can figure out slide 8, tells us that we go from September of 2023 to today. Mortgage rates were at 7.12. Then they went down. They've gone, as of the time that we got the slides made, they were at 6.80. Now, these are all numbers from Freddie Mac. So I don't have the exact number today, but I did tell you that we're at 6.686 was yesterday's number from OBMMI. But if you're looking at the chart, you can actually see that we've gone up, and then we've gone down, and we've gone up a little bit. Mortgage rates move all the time. We actually hit midweek, and it's not on this chart, because this chart is, again, Freddie Mac, and they only report their data on Thursdays. So they're collecting their data all week. Then they report on Thursdays. We actually hit 8.03 back in October, 8.03. Are we going back up there again? I doubt it. And I'm going to tell you right now that probably one of the toughest thing anybody ever does is to try and forecast interest rates. If Jerome Powell can't figure it out, if our friends over at Chapman University can't figure it out, do you really think I'm going to be the one that's figuring this out? No, but I am studying it, and I want you to understand why we are, where we're potentially heading, and why. Because right now, 78.7% of mortgage rates are less than 5%. That is according to FHFA. 78.7% of mortgage rates are less than 5%. But what is that really telling us? Well, those folks that are less than 5%, unless there's some catalyst, they're not doing anything with their loans. Unless they need to right size, or they've got a divorce, or someone passed on, they're having kids, any of the above, they're not doing anything with that loan. They're going to keep that loan unless they've got boatloads of equity. See, we've seen over time that people with a lot of equity, they're not as concerned with what the interest rates are because they're not paying a lot on the mortgage. So they may say, you know something, if I've got a very small payment and it goes from $1,000 to $1,100, they may not care if they get the house they want, the location they want, if they're by their kids when they want to be by them. So they may not care. So the idea is we talk about a rate lock. And when we talk about being rate locked or homeowners being rate locked, there's two different things here. Rate lock, when you talk about a mortgage, is one issue. That's how long you have until you consummate the loan. But being rate locked is where homeowners are sitting there and saying, you know something, I've got a 3% mortgage, which 22.6% of the population does, or less, less than 3%. I'm not going to do anything with it. I just had a speaking engagement yesterday, and a couple of people came up to me and said, Ron, I've got, or you helped me get 2.625 interest rate. And we weren't talking about their APR. We were just talking about where they were at the time. And I said, unless there's a need or a very, very specific strategy, don't change that. Keep it exactly where you are. That's a great place to be. Why would you want to change if you don't have to? So I'm just throwing that out there for you. It might be a little bit better for you to keep that one. Now, one of them, we're going to do a reverse mortgage second for them. That's a different kind of a product. So that particular individual, that's what's right for their situation. Every individual has their own situation. I don't want you to think that just because a reverse mortgage second is the right answer for that person, it's the right answer for you. Because there's another individual that we were looking at the Home Select product that Geneva has. rsrhomeselect.com is where you can get the video on that. rsrhomeselect.com. So don't think that just because you're sitting there, you're going to have to stay there. Now, the other part of it is the concept of debts. And many people don't talk about their debts. They have two baskets. They've got all their debts as one basket, and they've got another basket. They think it's separate for their credit card, auto, non-secured, private student loans, all that other debt. Maybe furniture. And they're 20, 25, 30% on some of that. Well, use some of your home equity and get that down, even if you're going into a home loan that's using the OBMMI number of 6.686. Not an offer to lend. That's not the APR. I'm just telling you that's what OBMMI says that people locked at yesterday. You can't do it today. But 6.686. Now think about that concept. How much money are you going to save on your overall your debt? Could be thousands. Now you put that same money toward principal every month, and your effective interest rate goes way, way down, and you pay everything off way quicker. Just remember that that's where the part of the process is. So that lock-in effect that we talk about, that people are in the 3s and 4s, we may start getting past that. Lance Lambert, founder of Resi Club, comment from him, a quote from him: "We might be at peak lock-in effect. Some move-up or lifestyle sellers might be coming to terms with the fact 3 and 4% mortgage rates are not returning anytime soon. If the lock-in effect eases up further in 2024, it could help boost existing home sales from the very low levels experienced at the end of 2023. And Erica Plemons, housing analyst from Bright MLS, one of the biggest MLSs in the country, quote, "Homeowners are selling aren't influenced by rates, with 90.5% of successful November sellers stating they were going to sell regardless of what rates were." Think about that. That's those people that don't have a huge amount of debt payment or interest or loan payment. They might be the ones that have a lot of equity. Top 3 reasons buyers paused their decision, reasons given for pausing their purchase. Multiple could be chosen, so it's not just one choice. That's why it doesn't come up to 100. Mortgage rates was the number one reason people were pausing, 72.1%. Inventory, 34.4%. Affordability, 17.4%. And when we come back, I'm going to talk to you about what determines mortgage rates. We're going to talk about what determines mortgage rates when we come back. We're going to continue our deep dive into what's going on in mortgage rates. And I want to talk to you a little bit about what determines mortgage rates. How do we come up with these rates? And it's important here that I share with you this number that I told you in the mortgage minute earlier that's going to be important. 4.1396. Can we just call that 4.14? I'm going to. So that's 4.14. So when we look at mortgage rates and what determines mortgage rates, we start off looking at the 10-year Treasury. Mortgage rates follow the 10-year Treasury fairly close. They're not exact, but they are close. So you take the current 10-year Treasury, which if you look at when we did the chart says 4.13. Today it's 4.14, so it's not a big difference. So you say that 4.13, and then you put a spread between what the mortgage rate is and what the 10-year Treasury is. Right now we're looking at 2.79 is what it was when we did that chart, which means a 6.92. So it's come down about 4 basis points. So right now I told you it was 6.686 was yesterday's number, 4.13. Let's use these because they're really, really close, and I've already got the charts made. So you take the 10-year Treasury and add the spread, and you come up with a mortgage rate of 6.92. Now, history tells us that over time, over the last 50 years, that spread is normally a 1.72 spread. When do we see the spread expand like it is today? Well, when you've got interest rates that are high and the market is forecasting them to go down, that spread will increase. Why? And I know I'm getting into the weeds here, but I want you to understand why that happens. So that happens because what's gone on is the servicers pay mortgage companies for the right to service a loan. And they expect they're going to be keeping that loan for 5.2 years. But right now, as interest rates come down, those servicers know that people are going to refinance as soon as it makes sense for them. So the servicers can't pay as much for that servicing fee. Well, if they can't pay as much for the servicing fee, that the mortgage rates have to cover it instead. So that's why we've got that 2.79 spread instead of the 1.72 spread. And according to Odetta Cushy, Deputy Chief Economist of First American, the spread is not always consistent. It actually widens during periods of economic or geopolitical uncertainty, as has been the case in today's market. So again, 2.79 is where that spread is. And you can see that the rates do move in unison over time. And if you look, what would happen if that spread was 1.72 today? Not changing that 10-year treasury, because that's going to be a consistent. 10-year treasury is what the 10-year treasury is. Market determines that. The spread is if we have less uncertainty. And you can see if we put that 1.72 on there, the rate today could be 5.85. So we don't even need anything to happen but get uncertainty out of the market, and we would get down to that 5.85. Do I think that'll happen? I don't know, but there's a lot of people saying that mortgage rates are going to go into the fives. Now, when we hear in the fives, we think 5%. 5.99 is in the fives. 5.85 is in the fives. So don't think that just because we have one number, that's the only number that is in there. Let's see what some other experts have to say. Mark Fleming, Chief Economist of First American, a primary driver of the increase in the yield over 2023 was inflation expectations. So the higher the current rate of inflation, and more importantly, the higher the expected future rates of inflation, the higher the yield on the 10-year as investors demand to be compensated for that inflation risk into the future. Inflation is the arch enemy of bonds. Goldman Sachs, December FOMC recap. That's the Federal Reserve's Open Market Committee. We now forecast 3 consecutive 25 basis point cuts in March, May, and June to reset the policy rate from a level that Powell has recently taken to describing as well into restrictive territory rather than just restrictive. I don't believe the same thing as Goldman Sachs. I don't think we're going to see a rate cut in March, maybe May. Let's take a look. Doug Duncan, Senior Vice President, Chief Economist, Fannie Mae. We anticipate that after the past several years of extreme volatility in interest rates, the 30-year fixed-rate mortgage will continue to moderate over the course of 2024, moving toward a rate below 6% by the end of the year. We're talking about that in the fives again. So let's see what some experts have to say. Fannie Mae mortgage rate projections. They're saying by the third quarter of 2024, that's just a few months away, 6%. By the fourth quarter, 5.8%. 5.8% in the fourth quarter compared to 6.5 in 2023 Q4. So if somebody's calling you today and saying, hey, let's refinance today, maybe you ought to ask them, what are we going to do then in the end of the 2024, or what is their game plan? Now remember, strategy beats rate always. Strategy beats rate always. So with that concept, what I want you to understand there is don't forget about our two-step, rsr2step.com, because you may go right now and do that restructuring of your finances. Now, there is a cost to doing a cash-out refinance. It's what they call a loan level price adjustment. What I'm sharing with you here is when you do that loan level price adjustment, when you have that for the cash out, well, if you did that right now at, let's say, 7% interest, and you consolidated all of your debt into one mortgage, and then you wait and you say, okay, in the fourth quarter, that's going to go down, hypothetically, no promises, 1.25 points. Well, you're going to save a lot of money by doing the two-step. Step one, consolidate now with that cash out refinance. Step two, which will be, you might get, actually the two-step might have two steps in step two. Because what may end up happening is in step two, you may actually find out that your credit scores have improved. So you get a better rate because interest rates are down, and you get a better rate because your credit scores have improved. Dean Baker, senior economist, Center for Economic Research. It also appears that mortgage rates are now falling again. They'll almost certainly not fall to pandemic lows, although we may soon see rates under 6%, which would be low by pre-Great Recession standards. Mark Fleming again, there's reason to believe that the rate lock-in effect will ease modestly this year as mortgage rates come down. And you can only imagine if they got below 6, then even more people would again be in the money and homeowners will become less anchored to that low interest rate. So the last thing I want to talk to you about on this is home price forecasts. Again, I just did that in the real-time real estate segment. But think about this. If interest rates go down, we get more people coming on the market. More people are able to afford. The affordability numbers get better. And we'll start seeing more demand, which pushes prices up. Now, the supply will go up, but there's been a lot of pent-up demand over time. So we're going to be watching all of that for you.